In this video, we will explore about understanding the industry landscape. To truly understand a business, you have to imagine it sitting right in the center of a complex web. As you can see here, the business is not alone. It is constantly interacting with competitors, customers, suppliers, regulators, and even emerging technologies. This is what we call the industry landscape. Now, why does this matter? It matters because the intensity of the competition determines how much money a company can make. Let us look at two scenarios. In scenario A, we have low competition. Here, if the cost of raw materials goes up, the business can simply pass that cost on to the customers. The result is that their profit margin remains intact. But look at scenario B, where there is high competition. Here, the company cannot just raise prices because customers will simply go elsewhere. This pricing pressure prevents them from transferring costs, and the result is reduced profits. There is a very famous framework used to analyze this landscape, and that is Michael Porter's 5-force model. Developed by Dr. Michael Porter in 1979, this model helps us decide if an industry is attractive for investment. Think of the industry as a battlefield. In the center, you have the rivalry among existing players, but there are also 4 other forces pushing in. From the sides, we have the horizontal forces, which are the threat of new entrants and the threat of substitutes. From the top and bottom, we have the vertical forces, which are the bargaining power of suppliers and the bargaining power of customers. Let us break these down one by one. First, let us look at the center of the battlefield, industry rivalry. As Charlie Munger from Berkshire Hathaway famously said, if the only basis of competition in an industry is pricing, it is a self-defeating business. When rivalry is high, you see many companies all fighting for the same space. They offer similar products with very little difference, and the only way they know how to fight is by lowering prices. A classic example is the telecom industry in India. Subscribers are very price sensitive and will switch networks for a cheaper plan. This hurts everyone's profits. On the other hand, look at a company like Micromax. They gained a 10% market share not just by fighting on price, but by differentiating their phones with specific features. Next, we have the threat of substitutes. This is often described as evolution versus extinction. A substitute is not just a competitor, it is a completely new way of solving a problem that makes the old way obsolete. Think about how SMS faded away when WhatsApp arrived, or how plastic pipes replaced steel pipes. The most cautionary tale here is the Kodak paradox. Kodak actually invented the digital camera, but they were so focused on protecting their film business that they failed to adapt. They filed for bankruptcy because innovation rendered their existing model irrelevant. However, some industries like power, healthcare, and education are resilient. The service remains essential even if the mode changes. Now, let's talk about the bargaining power of buyers. Imagine a weighing scale. On one side, you have the buyer power. This power is high when there are many sellers offering standardized products. If you are selling the exact same thing as 20 other people, the buyer dictates the price. However, buyer power is low when there are few sellers and the products are unique. If you have something no one else has, you hold the power. Factors that increase buyer power include low switching costs, meaning it is easy for them to leave you, and large influential buyers like the government. On the flip side, we have the bargaining power of suppliers. Think of this as a bottleneck. Sometimes the supplier holds all the cards. We call this absolute power. For example, in a hospital or a school, consumers rarely bargain over fees. The supplier dictates the terms In contrast, think of a vegetable vendor. Here, the supplier has almost nil power because consumers bargain constantly and there is high competition. A good example of strong supplier power is the oil industry, where OPEC controls the output to maintain price levels, or the sugar industry, where farmers and the government decide raw material prices. The final force is the threat of new entrants or barriers to entry. Warren Buffett puts this perfectly. He says, in business, I look for economic castles protected by unbreachable moats. A moat is a barrier that protects your profits. We have a checklist for these barriers. They can be licensing requirements, patents and copyrights, or a need for huge capital investment, like in the oil and gas sector. They could also be specialized assets or skills, common in IT products, or strong brand loyalty, like we see with toothpaste or coffee. The harder it is for a new player to enter, the better it is for the existing businesses. So, how do we summarize this? We can divide industries into attractive and unattractive categories. An attractive industry which builds shareholder wealth has low competition, high entry barriers, and weak power from suppliers and buyers. Examples would be FMCG, healthcare, and IT. An unattractive industry struggles with low profits because of high rivalry, low barriers, and strong forces from buyers and suppliers. Examples include aviation, telecom, and retail. A gold standard example of an attractive industry in India is education. It has ample demand, high barriers due to permissions, weak supplier power regarding teachers, and weak buyer power from students. Now that we understand the industry, let us zoom out and look at the macro factors using PESTLE analysis. PESTLE stands for political, economic, socio, cultural, technological, legal, and environmental factors. Starting with political, we look for stability and fiscal policy. Is the structure capitalist or communist? Next is economic. We look at GDP, growth, inflation, and forex reserves. India, for instance, has seen varied economic phases. Then we have socio-cultural factors. Demographics play a huge role here. A young population creates opportunities and lifestyle changes like more nuclear families, increased demand for packaged foods and daycare. Continuing with PESTLE, we have the technological factor. A tech-savvy population and a focus on R&D are essential for scaling a business. Then there is the legal factor. Businesses prefer transparency and consistency. A risk example here is the Vodafone retrospective tax case, which created discomfort for investors. Finally, the environmental factor. This includes pollution norms and waste disposal. Ambiguous policies here can deter manufacturing investment. All these external factors shape the playground where businesses operate. Moving on to portfolio analysis, we have the Boston Consulting Group or BCG analysis. This matrix helps companies analyze their product lines based on two things: relative market share, which drives cash generation, and market growth rate, which uses up cash. We divide businesses into four quadrants: stars, question marks, cash cows, and dogs. Let us understand what each of these means for a business owner. First, we have stars. These are high growth, high share businesses. They generate cash but also need heavy investment to keep growing. An example is Serra Sanitary Ware. Then we have question marks. These are high growth but low share. They consume cash and their success is uncertain. The Bajaj Pulsar was a success here, while the Tata Nano was a failure. Next are the cash cows. These have low growth but high market share. They provide steady cash flow with low investment needs. Nowneat Publications and Colgate are great examples. Finally, we have dogs. These have low growth and low share, generating very little cash. Another useful framework is the SCP analysis, which stands for Structure, Conduct, and Performance. This is an extension of Porter's model that links the industry setup directly to financial outcomes. It flows in a logical order. First, you have the structure. For example, is it a monopoly or an oligopoly? This structure dictates the conduct, such as whether the product is commoditized or specialized, and that conduct leads to the performance measured by metrics like return on equity or WACC. Let us break down the first two parts. Structure analysis is the setup. We look at competitive intensity, the number of players, and whether the market is organized or unorganized. We also look at the concentration, meaning is the industry dominated by just a few players? Then comes conduct analysis or the behavior. How does the industry behave? Is there seasonality like with umbrellas? Is there cyclicality like with real estate, which depends on interest rates? Or is it based on specialization and brand power like in FMCG? Finally, all of this leads to performance analysis, the output. Based on the structure and conduct, the industry generates financials for the owners. The key metrics we look at here are ROE, which is return on equity, ROIC or return on invested capital, and WACC, which is the weighted average cost of capital. The ultimate goal of all this analysis is to identify businesses with high return ratios that can create long-term wealth. These numbers are simply the mathematical result of the strategic landscape we have just explored.